I'm John Hanna for CDTV.net in New York, and we have Maureen Maitland, the Vice President for S&P Indices, and we also have Dirk Van Dyke, Chief Equity Strategist at Zacks.com, joining us from Dayton, Ohio. Thanks for joining us.
Good to be.
Thank you.
All right, let's start off with you, Dirk. Let's talk about the S&P 500 Case-Shiller Index.
Um, well, I mean, it is the gold standard of housing price indexes because it's a repeat sales index. I think Maureen could probably go into the details better than I. The one drawback is it tends to be somewhat tardy information. The data that came out this morning was for April, and that's actually a 3-month weighted moving average. So it actually includes some data from March and February in there. But it, as a repeat sales index, a much better way of tracking things than, say, the median home price or something like that from existing home sales. And we finally got some pretty good news. Now, I prefer to focus on the seasonally adjusted numbers because there is a distinct seasonal pattern in housing prices rather than the unadjusted numbers that tend to get most of the press attention. And on that basis, the composite 10 index was up ever so slightly, 0.1%, but even that's a very welcome change. And the composite 20, which includes the composite 10, was down less than 0.1%, 0.9%. For the month. And on a year-over-year basis, the composite 10 was down 3.05%, and the composite 20 was down 3.93%. But from the peak in April of 2006, the declines are almost identical, 31.80% for the composite 10 and 31.76% for the composite 20. 9 cities were up and 11 metropolitan areas were down on a month-to-month basis. On a year-over-year basis, only Washington, D.C. was into the positive territory. Everybody else was down. But just seeing some stabilization in housing prices is a very positive sign. And unlike the previous upturn, I mean, we had a big decline from the peak of the bubble in 2006 through early 2009, and then had a bit of a small upward bounce that lasted until about a year ago. But that upward bounce was really due to extraordinary government support for in the form of the housing tax credit. There's a classic thing in economics. If you have a third party that subsidizes a transaction, and certainly an $8,000 tax credit to home buyers is a classic example of that. That subsidy tends to get split between both the buyer and the seller. The buyer gets his in the form of a tax credit, when he gets around to filing his taxes in April, where the seller tends to get it in the form of a higher price. And so that was an artificial boost. This stabilization is happening without any of that extraordinary support and is extremely welcome. I really see housing as, the principal reason why we've got such a anemic recovery this time around. Historically, residential investment is the locomotive that pulls America out of recessions, and that locomotive has simply been derailed this time around. And now the Case-Shiller Index tracks existing home sales and prices, and prices are really what are important when it comes to existing homes. They represent the most important store of wealth for middle-class Americans, or at least they did before it all evaporated. by not falling, it means that not as many people are going to be underwater on their mortgages, and you really need to be underwater before you can have a foreclosure happen. I mean, regardless of how bad your cash flow situation is. I mean, you could be divorced, have all sorts of health problems, lose your job, etc. As long as the value of the house is more than the value of the mortgage, it's in your interest to just sell the house rather than let the bank take over and get nothing for it. So by stabilizing, we're not going to see further increases in the foreclosure situation. That's not going to happen, immediately, because there's still a lot of people who are already underwater. But that potential pool of foreclosures is not getting bigger.
Okay,
I'll
Maureen.
stop here and let Maureen talk a little bit.
Okay, Maureen. With your data that you have on hand, where do you see the trend of the housing market within the summertime? I mean, in summertime, usually typically is more people go out and look at houses and rentals and all that stuff. Where do you see this trend going towards?
Well, that's the big question right now because as Dirk had said, the numbers were good for April, but that's really just 1 month of data. And if you look at the annual trend, there wasn't an improvement in the annual growth rate. So that's a little bit disturbing. So what we need to see, not only do we expect to see on a relative basis home prices go up during the spring and summer months because it is, as you said, they are seasonal data. The issue is whether they're going to go up enough to really have a recovery or if they're just going to go up because of a seasonal blip. That's the big question that everybody has right now. And we really only have 1 month of data for April that so far supports the seasonal patterns. We have a lot more questions out there than we have answers at this point.
And how do you put up these numbers here, the S&P Case-Shiller index?
How do we? You want to understand our methodology?
Yeah.
What we do is that we look at actual home sales. We'll look at the physical home sale, nothing with appraisals, and match it compared to the last time the house sold. So we're looking at thousands of transactions every single month, which, by the way, is one of the reasons why there is a bit of a lag. We're processing so much data and trying to confirm that each home that sells is exactly the same or very similar to the way it was prior to the sale. And then we measure the growth rate. So we're doing that across tens of thousands of home sales each month. And that's what we call the sales pair or the repeat sales methodology.
Okay, now with all of this data on hand, like I said, it's kind of like it's still the open question is that what's going to happen next. But what do you think the housing market needs at this point to actually nudge it for a positive sale?
Well, what we see needs to happen, and it will differ across the regions, is for a lot of this inventory overhang to just work itself off. And that's happening more slowly than a lot of people had hoped. So there's a lot more homes out there that people want to sell than there are buyers. And that process may take a bit longer than just a couple of months. But in the meantime, at a minimum, at least some stability. And right now the stability is sort of, we're bouncing along the bottom. You're seeing that with housing starts, you're seeing that with existing home sales, and you're seeing that with home prices, is that they appear to have possibly troughed. They're possibly at their lows. We're not certain that they're at the absolute lows. But as Dirk has said, some stability, any stability is welcome. And then from there on, we all want to see growth. The big question is right now, given the historic amount of overhang, the historic amount of inventories that are out there in the market, how long is that going to take? And I think a lot of people do believe that it may take the rest of this year.
Dirk, question?
Yeah, I'm very much in that camp. We're a lot closer to the bottom than top. I'm not convinced that we've completed, but if somebody is planning on buying a house to live in it, is buying a home, I think they're in pretty safe territory. Probably my best estimate is we're 3 to 5% from the bottom at the most. Now that doesn't mean that once we get there, we're going to shoot back up, and we may actually see, in real terms, house prices continue to decline for a little longer. But I think in nominal terms, we're awfully close to the lows. And unlike last time around, when we had these extraordinary month supply, where existing home sales were 9.3 months in May, which is a very high level. 6 months is about normal, and we were about 4 months during the housing bubble. But this time we're not likely to see that because housing prices are, quite frankly, much more reasonable. I mean, they're not cheap, but based on the how much it costs to rent versus buy, and also relative to median incomes, we're back basically to historical norms, as opposed to being wildly, wildly inflated the way we were in 2006 and 2007. So there is a floor, and we're actually starting to see rents rise as the vacancy rate in terms of what we need to really get things back on track. I would say we need more jobs. That will raise the level of household formation, basically economists speak, for junior getting out of mom and dad's basement and getting a place on his own. And when that happens, then we start seeing a lot more of the absorption of this excess supply. So I think first you see a stabilization in prices, then some more absorption in the rental market, perhaps a pickup in existing home sales, and then finally, once some of this excess distressed inventory is worked off, we'll finally start seeing some improvement in new home sales and in home building, and that then creates a great virtuous cycle, because when you start putting people to work building houses, then they've got the income to be able to afford a place of their own, and that in turn means that there is more need for housing, which means more people go to work in the construction sector, which has been particularly hard hit in this recession, plus in all the factories that produce the materials for housing, and a lot of the ancillary businesses. So it's not happening yet, but eventually it is going to happen, and that's going to be a huge boost to the economy. We'll get that locomotive back on track and pulling, and that is when that happens, it's going to be pretty powerful, because there's a lot of pent-up demand at this point.
Thank you, Dirk. Closing statement, Maureen?
No, basically what Dirk has said is very much, I think a lot of people believe that is exactly what's going on in the market. The other thing that will need to happen is, as housing is affordable compared to where it was 3 years ago. There's no doubt about that. But people need to also be able to get mortgages. And so we've heard a lot of stories about banks aren't lending the way they used to, which is probably appropriate given the subprime crisis. However, getting a mortgage, people need to, once they enter the market, they need to be able to get the mortgage. And we've heard a lot of stories about the whole credit crisis and the issue that a lot of banks just aren't lending the way they used to. So once people enter the market, get their jobs, we're hoping that to see the banks ease up on their credit lending standards and at least get some of these people the mortgages that they need.
That's Maureen Maitland, Vice President for S&P Indices, joining us in New York, and Dirk Van Dyke, Chief Equity Strategist at Zacks.com, joining us from Dayton, Ohio. Thank you.